If there were any doubts about the U.S. administration's soft dollar policy, those doubts were put to rest on Wednesday. U.S. Treasury Secretary Mnuchin followed up this week's introduction of U.S. tariffs on solar equipment and washing machine imports with the comment that a weaker dollar was good for the U.S. as it related to trade and opportunities. The U.S. administration's soft dollar policy campaign was already a behind-the-scenes but effective driver of much of the 2017 dollar weakness. And in 2018, we're seeing a ramping up of this campaign, something that we had warned about for many months. The move to such an overly bearish stance on the dollar has resulted in the Wednesday collapse, with currencies rocketing across the board as a consequence. Of course, record high Eurozone manufacturing PMI print, solid UK jobs report, and weakness in US existing home sales only added to the dollar debacle. Still, these moves to promote an America First agenda will not go without response, and all of this will add to the fire of what is turning into a full-on currency war. This will bring added attention to tomorrow's ECB event risk, with the market to hang on Draghi's every word for any indication of pushback on what is likely to be viewed as a rapid and unwelcome appreciation in the euro. Draghi is certainly capable of leaning more to the accommodative side in an effort to combat the dollar weakness, but with the Eurozone recovery in swing, the central banker will have his hands full. Other notable calendar events on Thursday include New Zealand CPI, German GfK consumer confidence, and German IFO readings. Canada retail sales and U.S. new home sales are out as well. Looking back at the scorecard for Wednesday into the European close, the Canadian dollar was about up 0.75% and was the weakest of the developed currencies against the buck. The pound was the big winner on the day, up over 1.5%. But perhaps one of the most interesting takeaways from the day that was the healthy demand for safe haven markets like the yen, Swiss franc, and gold, despite the ongoing record run in U.S. equities. And so the question that comes from this is the following: is this newfound demand for traditionally safe haven assets warning of an overdue shakeup in the stock market and concurrent deterioration in global sentiment? That's all for now.